Uncertain times, they are not just coming, they are here. While the headlines distract with flash in the pan headlines and brief economic figures, the real story is economic dislocation, devalued currencies, inflated markets, and a growing crisis of trust in our governments and our systems. So how do you protect your wealth when the old playbook fails? The answer is not sexy, but it is strategic. Gold. Every investor hears the same pitch: diversify, stay the course, trust the system. But as history has shown us time and time again, systems fail. And when they do, only real assets matter. Gold isn't just a commodity, it's a strategic asset, one with no counterparty risk, no expiration date, and no allegiance to politics or policy. In this episode, I am going to explain to you how to protect your wealth in uncertain times and why gold matters. Not just as a hedge, but as a core allocation, and how smart investors are positioning outside the system before the next crisis truly arrives. So where are we right now? We have geopolitical fragility, persistent inflation, global debt, de-dollarisation, protectionism, and markets are more bloated than ever. We've entered an era where trust in central institutions is rapidly deteriorating, and with it, faith in traditional portfolios. Stocks are overpriced, bonds are volatile, diversifiers like real estate and private equity, they're illiquid and mispriced. And add to that geopolitical fragmentation, supply chain dislocations, and a global economy that is just no longer moving in sync. Well, there are no safe assumptions left. The problem is no one knows what to assume anymore, and they are uncertain about where to turn to. Investor optimism peaked in early 2025, but so did risk. The University of Michigan's Consumer Sentiment Index collapsed, while inflation expectations spiked. And the result? A dangerous cocktail of stagnation and price pressure. Classic stagflation. And in stagflation, gold tends to win. The story of 2025 was meant to be about resilience. Things were looking relatively good. There were some strong GDP forecasts, bullish sentiment, and hopes pinned on deregulation and tax cuts. But that optimism has not lasted. We now see bearish sentiment surging. Inflation has reared its head again, and global confidence in Western leadership is wavering. And here's the truth: hope in politicians and exceptionalism is not a financial plan. For example, when the US sneezes, the world no longer just catches a cold, it questions the entire architecture of the system. And that is precisely why central banks from Asia to Latin America are hoarding gold. Over the last 5 years, global central banks have added more than 1,000 tons annually to their reserves. Why? Because they understand that when trust in the dollar erodes, gold is the only universally accepted fallback. Gold has delivered an 8% annualized return since the collapse of the gold standard in 1971. That is on par with equities without relying on earnings, management, or geopolitical calm. Its dual demand as investment and as a consumer good, that is what makes it uniquely resilient. In deflation, investors hoard it. In expansion, jewelry and tech sectors drive demand. And this makes gold perform not just in bad times, but in good times too. So it's not just an inflation hedge, it's a purchasing power protector, outperforming every major currency since 2000. And crucially, it does not rely on promises. Bonds, they can default. Currencies can be inflated away. Equities can be repriced overnight. Gold, it simply exists, unleveraged and unreplicable. As the Trump trade fades and equity valuations remain historically stretched, investors and financial institutions are rediscovering gold's relevance. You might be looking at headlines that focus on tech stocks or meme coins, but it's undeniable that there is a quiet shift into sovereign reserves. Russia, China, Turkey, and even Singapore, they are accumulating gold at record paces. This is not ideological, as we say time and time again, this is strategic. Because gold offers liquidity without liability. It doesn't depend on swift access or US policy. It can't be frozen, sanctioned, or erased. With over $5 trillion in central bank and investor holdings, gold is more than a commodity. It's a form of non-aligned monetary power. And it's no accident that central banks are buying while retail investors are slightly hesitant, because the central banks see the writing on the wall. So here is the truth. Most so-called diversifiers don't actually work in a crisis. Correlations rise, liquidity evaporates, the old 60-40 model doesn't hedge like it used to. Gold, it is different. It becomes more negatively correlated with equities during sell-offs. During the 2008 crash, gold rose 21% while everything else cratered. Same story during COVID and the sovereign debt crises. And it's not just anecdotes. Gold delivered positive returns in 8 of the 10 worst quarters for US equities over the past 50 years. In contrast, bonds, so-called the once safety net, have lost their ability to offset equity risk effectively. So if you just look at some numbers, adding even a 5% gold allocation to a traditional 60-40 mix improves risk-adjusted returns, it lowers drawdowns, and it enhances liquidity. Over at the World Gold Council, they have modeled this across every major time horizon. In higher risk portfolios, optimal allocations go up to 10% or more. Why? Because gold behaves differently. That is the point. Today's 60-40 portfolio beta is among the highest in the last 5 years. Bonds now mirror equity moves more closely. And what does that mean? Well, it means less protection. It means more exposure. Enter gold, the strategic offset. And just take a step back and remember how gold behaves when the world breaks. During the 1970s stagflation, gold rose over 1,200% while equity struggled. The 1987 Black Monday crisis, gold held its ground while markets crashed. The 2008 financial crisis, gold surged as Lehman Brothers fell. The 2020 COVID panic, equities plunged, but gold hit all-time highs. In every era of systemic stress, war, recession, collapse, gold has been the go-to. It does not require optimism, it just needs recognition. It's deep, it's liquid, and it's global. And this is why I really love it, it is borderless. With over $250 billion traded daily, it outpaces most government bonds and even equities. And in stress scenarios, when other markets seize up, gold keeps moving. It can be traded, even when everything else is frozen. Foreign central banks are seriously taking note because as pressures rise and countries turn their noses up at the dollar, sovereigns are quietly rotating out of treasuries and into gold. Why? Because when interest payments consume over 20% of US government revenue, the question isn't if risk is repricing, it's when. So what's the strategy here? Well, just start. Just start adding a bit of gold to your portfolio. For many, 5 to 10% of your net worth in physical gold is a good number to aim for. Blend vaulted bars for cost efficiency with coins for accessibility. And if security in retirement is on your mind, then get in touch with us at GoldCore to help you set up accounts that support this. And spread storage across safe jurisdictions, Singapore, Switzerland, Ireland, London, and the US. You can choose allocated, segregated storage, your name, your metal. And do not settle for paper gold. That's not protection. In fact, I would argue that that's abstraction. And if you're just starting out, well, why not start dollar cost averaging in? Why not just begin with a gold saver account? It's just 100 euros, pounds, or dollars a month, building that base layer faster than you think. It is a myth that gold is just for billionaires or macro hedge funds. It's for anyone serious about protecting what they've built. And I'm not telling you anything new. We've been here before. But throughout history, every major monetary system has fractured under the weight of its own contradictions, and people seem to forget it time and time again. Time and time again, we see systems collapse when the promises underpinning paper money could no longer hold. And today, we're living in the aftermath of the post-1971 fiat experiment, unbacked currencies, central banks as market makers, and an ocean of debt that is sustained by just confidence alone. And that confidence is wavering. As trust decays and transitions unfold, gold will be there, not as a relic, but as the one monetary asset that requires no infrastructure to matter. In the next monetary chapter, whatever form it takes, gold is not going away. It will just be repriced. This isn't about abandoning the system, it's about hedging against failure. Failure of the system? Yeah, but more like failure to prepare. Gold is not just for crises or for central banks who see the writing on the wall. It is for portfolios that plan. It preserves value when nothing else does. And in a world where uncertainty is the baseline, gold is not an outlier. It's the anchor. We have a new guide for you, how to protect your wealth in uncertain times. So click on the link below, download it, and let's get involved. Because in volatile markets, the best time to act is before the shock arrives.